Good evening. I am Paula Fontana, Vice President of Strategic Programming Initiatives with the National Black MBA Association, and it is my pleasure to welcome you this evening to Rewriting Your Future Through Financial Planning. So, the mission of the National Black MBA Association is to create the opportunities for students, professionals, and entrepreneurs throughout all stages of their careers through wealth building, growth, and educational opportunities. And we do this through a chapter model with our 40 chapters throughout the United States to enhance the lives of our 20,000 members and growing. And so this evening's event is in collaboration with one of those chapters, as well as the brainchild of the New York chapter. So I have to add this particular piece that last year we did a similar session in partnership with the New York chapter, as well as with Nasdaq, and it was the highest attended webinar that we had throughout the year. So I know you have so many great things in store for you this evening. Now, I also have the pleasure of introducing to you our first speaker for this evening, and that is Jill Malandrino. She is Global Markets Reporter and host of Trade Talks. So Jill's coverage focuses on cash equities, listed options, derivatives, passing, investing strategies, and NASDAQ products. Prior to joining NASDAQ, Jill was the product development manager for the Street's Options Profits and was formerly on the institutional equity trading desk of Prudential Equity Group and H.C. Wainwright. So I know that you are in wonderful hands. Jill, welcome and thank you so much. You may take it away.
All right, Paula, thank you so much. It is great to be back with this group. I remember the coverage that we did last year really was one of the highlights that we did with NASDAQ, and we're proud to partner, as always, with everyone here. And part of my coverage also extends into financial literacy and financial planning, which really is something that is personally and professionally near to my heart. So, on behalf of NASDAQ, we really are proud to partner with everyone again. With that, I want to introduce our panelists for this evening. We have Christina Massalay. She's the founder and CEO of Mass Financial Management, followed by Robert Ross, Senior Vice President at Wells Fargo Wealth and Investment Management. And we have Anthony Shropshire, Senior Vice President and Financial Advisor at Merrill Lynch. And Robert, I'd love to start with you because we shared this webinar last year together, and where we were then as to where we are now is quite remarkable. You and I were talking offline about this. So I'd like you to set the stage for us this evening. And let's talk about how COVID-19, what we've been going through with the pandemic, has impacted our investments, where we are in the markets now.
Sure. Thanks, Jill. Good to be back again. And I hope that we have a great discussion this evening. When you think about what we've been going through, the horrible consequences of the coronavirus, everybody staying at home, being on lockdown, all of these things, you would think that this was very disruptive and that the financial markets were challenged. You might be worried about your 401k, but I'm here to tell you that is not the case. And if you look at if you just bring up any market indice right now and just go back a year, I think we actually shut down in March last year. But if you look right now, you look at the Nasdaq is up 57% in the last 12 months. The S&P is up 40% in the last 12 months. And so, what it really says is that despite what's been going on, corporate profits and the fundamentals of the businesses that are in these indexes have had some of the best performance that we've seen in recent decades. So I would not have guessed that to be the case. So you really, despite all the noise, you got to stick to the facts. Performance is personal, performance is local. So you might own some companies that did not benefit, but you really had to go way out of your way to find them, because the Nasdaq, the S&P, and the Dow, so big stocks, medium-sized stocks, and small stocks are all, as a group, all making new highs.
And Christina, we know the major averages did really well throughout the pandemic, and again, the recovery was remarkable. Which areas did you see any losses during this period, and why?
Yeah, definitely. We saw some of the sectors that had losses, and obviously in retail, we saw some of the restaurants, real estate, we saw losses there. We saw some losses overall in healthcare, which is rebounding as well, especially with telemedicine and things of that nature. But the why is when you look overall, everything is, I say, is based on most things, supply and demand, right? And so as things began shutting down and we started going into quarantines and lockdowns, and shops weren't open where people could go in and actually spend money, we're in a consumer-driven capitalist society, we saw things begin to taper off, right? And so those are some of the sectors. But just like Robert mentioned, we're seeing rebounds and double digits and across the board. We saw airlines, for instance, people are not traveling. So we saw airlines, that industry get hit. We saw cruises getting hit. We look at tourism. I mean, something came out today in regards to tourism, and the amount that we've lost over this past, it's greater than a year at this point in time. And those things, I expect them to rebound over time, because there's a lot of pent up demand. No matter who you speak to, people are just ready to really get back out, to engage and to go forward. But those are some of the areas that we saw get hit.
Yeah, so Anthony, we're very well aware of that the stock market is one thing and the economy is something else. They do not go hand in hand at the end of the day. And we've seen that K-shaped recovery where some areas have done really well and some continue to struggle. So what have you had to do differently as a financial advisor to support the changes that we're seeing in the economy while explaining to clients what's happening in the market?
Yeah, I mean, I think that in terms of what I've had to do differently as an advisor, I would say nothing, right? And that's because, at the end of the day, what we're looking to do is we're trying to match individuals, asset allocations in their portfolios with their goals, their time horizon, their risk tolerance. And markets change every day, right? We just had, a year in which a lot of change happened at the same time. But, the market is really a discounting mechanism for what it expects to happen in the future. And so, we all are messaged that we're going to be staying home in March, and we start to understand what the impact of, an actual shutdown could potentially be. You see asset prices really coming down ahead of the actual closures of stores and retail and real estate and things of that nature. And then with all of the stimulus that the Fed has injected into the economy, and with news of a vaccine and things of that nature, the market has started to react in a positive way because of the reopening piece of it all, right? So I think that as an advisor, we don't necessarily change anything that we're doing on a day-to-day basis. What we still want to do is make sure that the plan that we put together for our clients is still relevant to them, right? Certainly, there's significant amount of volatility around this time last year, but what's your time horizon? Do you have any liquidity needs? Do you really need to pull out of the market at probably one of the worst times possible? Or have we actually thought about this? Have we built into your plan, thoughts in a game plan around potential disruption in areas like this, where maybe we have some clients who actually have the ability to think long-term and buy cheap assets, quality assets on the cheap, right? So I think that, if I get like goosebumps thinking about this time last year, because the only thing that was a lot different was that I had to kind of stop the world. I stopped acquisition mode. I was not looking to acquire any new clients. And what we needed to do was make sure that the people who we serve are making sure that they're hearing from us, making sure that they're getting steady advice, and making sure that they're not making any mistakes. So it was challenging. Sometimes it felt like there was not enough hours in the day to reach out to everybody and answer everyone's questions. But, through technology, right, firms like Roberts and mine and, and individuals like Christina who can reach out to individuals, are able to get really good information out to people in a much faster way than we could have maybe a decade ago, whereas more people probably made some more mistakes because they didn't have that personal touch or availability to get information as quickly as they were this time around.
And Anthony, that's such a great point that you make, because I think one of the silver linings to the pandemic is, and I applaud the financial advisory industry for how they pivoted and leveraged technology and being in front with their clients. I think that really was key to the success that we saw as we get to the other side. But one of the other silver linings, of course, is new investors are getting interested in the market. They had the opportunity to, and I think as we look at the broader cultural picture with looking at diversity, inclusion, and belonging, and bringing financial literacy to underserved communities, the access to education exposure is certainly a home run out of all this. And a lot of new investors are onboarding. So Robert, with that said, with newer investors that are coming on, you know, when you talk about long-term planning, has your strategy shifted at all, or do you still recommend, you know, ride this out for the long term?
Well, you know, it's investing is personal. And so we really do have to tie it to the individual situation. So for first-time investors, you know, if somebody's been sitting in cash, there's no yield on cash, 2-3 basis points. So a lot of people who have invested, say, in real estate, and haven't really invested in financial markets. Most recently, real estate's been challenged because of the impact on commercial and retail. And so that's forced a lot of investors to start to look for other places. And so they're sitting on cash, and now they're looking for a good return. And so when they come to the markets, we think, you know, you need to build their asset allocation, but it's a target. We don't have to get to the target asset allocation right away. So you want to kind of average people in and get them comfortable. Today's economy, we get a lot of noise, and that noise can distract investors. So we try to build them in, dollar cost average them in, get them invested over time, you know, using fully diversified portfolios. And in today's market, the returns have been, it's people can, you know, it's a philosophical thing. It's a bit of an art and a science to it. But one of the worst things that can happen is to have new investors come in, and in the first year, they make 20% on their money. You got to explain to them that this is not normal, that the long-term averages are much lower, and they nod, but they kind of feel like, hey, we made 20% the first year, let's put it all in. They don't want to stick to the asset allocation. So these are interesting markets to bring new investors in, because we're seeing returns that are way above the historical averages. But you have to keep it personal. I think one of the probably most important things, given the amount of unemployment that we've experienced, cash reserves. You know, having enough cash reserve to weather a storm is really important now. Even if you're not getting a good yield, people need to have some liquidity in the event that their cash flow is disrupted. And so we've seen extraordinary unemployment during this period, despite what's going on in the markets.
Robert, that's actually a good point, especially, and you're probably alluding to, and people should just take the advice here, is probably extend even the cash reserve to even longer. And so I've even worked with some nonprofit organizations as well, who historically they do a 6-month emergency fund particularly, and just extending that out much greater. So whatever your normal, we usually recommend 3 to 6 months, but sometimes you have to go a little bit longer in these times.
Christina, I actually have a follow-up to that. And before I get back to you, I just want to remind everyone that you can certainly put questions into the Q&A function at the bottom of the Zoom screen, because we're going to set aside 10-15 minutes at the end to take the audience questions. So please be sure to pull those as we're speaking. But Christina, last time, a year ago when we spoke, one of the things that came up was around income and resources that have been impacted by COVID-19 over the past 12 months. And while there has been some recovery there, even outside of the pandemic, what are 3 items we should always pay on time if you can't afford to pay everything right now?
Yeah, no, that's a great question, Jill. So one of the things you want to make sure you have a place to stay. If your income is at least sufficient, where you can afford to continuously pay a certain amount of your bills, you want to have a place that you can rest your head. So I would say your rent, your mortgage, and there's moratoriums that have been put in place. Those are slated to expire this year. So during this time frame, hopefully people are able to just continue to build up some of that cushion. Actually, one of the things we saw at the end of last year was that the personal savings rate actually went up to one of the highest levels since like the 70s, because people were actually able to take some more money and save it because of, like Anthony mentioned, the stimulus and unemployment benefits, et cetera. But you want to have a place to stay. I would also encourage people to make sure you have some level of health insurance, right? So this goes hand in hand with the overall well-being and taking care of yourself. And then another point I would say is, especially with not just COVID, there could always be another variant of anything that can come up, right? And so right now we're able to get the vaccinations without showing any health insurance or anything of that nature, but we don't know what the future will bring, providing we have to get booster shots and all of these things going forward in the future. But I would definitely encourage people to have a level of health insurance. And then you don't want to destroy your credit during this period, because this is literally what we have to represent us when we go out to finance anything. If you want to go and buy a house, if you want to go and get a car, if you want to get anything, and literally in a matter of months, you can literally destroy your credit that you work so hard to actually build. So if you're not able to afford to make the full payments at the end of every month, I would definitely encourage people to pay at least the minimum balances on those, so that you won't have an adverse credit rating. It takes a long time to get it built back up. I'm going to just add one other one, Jill. I know you mentioned three, but just, I mean, I'm big on sustenance and overall well-being. So in terms of staying physically fit, trying to exercise, trying to be well, because I mean, for me, I say that that's a form of healthcare and health insurance as well. But just find a way to take care of yourself. Try to eat right as well, because overall that's going to impact how much you're going to also pay in terms of healthcare costs, and it will impact your overall livelihood as well.
Yeah, I would add one thing. In my house, you got to pay the wireless phone bill. If those phones go down, we're in trouble.
That's true.
I would agree with you there. And Christina, you made such a great point about credit, especially in the housing market we're in right now, where it's so competitive that once everyone's coming out of their houses, you have money saved. It's just such a quick market. And having just gone through this myself, the sellers were exceptionally picky when it comes to cash availability and credit worthiness. So Anthony, I wanted to shift gears a bit and talk about retirement. And we've spoken a lot about having a cash reserve and making sure you have the 3, 6, 9 months savings. Are you seeing anything out there where people are dialing back on their 401ks, or perhaps contribute less to their retirement and moving that instead to cash? I feel like there's a fine line there, because we're always saying there's no yield in cash, but we're also talking about putting money to the side. So how do you properly balance this?
Yeah, I mean, I think that one of the quote unquote easiest places to save over the long term is if you're fortunate to have a corporate retirement plan, like a 401k or 403b or 457. And so, there's a couple things that make it easy. One of them being that it comes directly out of your paycheck. Depending on your income, right, that might be the only tax deduction that you're able to get or able to find. And, typically with corporate retirement plans, you can't touch the dollars until you're 59 and a half. So we typically, are advising clients who do have the wherewithal to do so to max out their 401ks where they have the availability to do so. And again, it kind of goes back to the first comment and just thinking big picture, thinking about time in the market instead of timing the market. And so, if you have the ability to consistently save in any place and you have a retirement account like a 401k, that's typically a place where people try not to disrupt that. especially if you get an employer-sponsored match, right? That's kind of like free money that maybe folks may be leaving on the table if they don't do that. So, you know, what I found by and large, and maybe 2008 is really fresh in the minds of many people. A lot of folks weren't really panicking, you know, the way you would probably expect them to from the outside looking in. You know, I can only speak for myself and my client base, but what I felt was by and large, a lot of folks were saying, hey, look, you know, things are a little tough right now. This is certainly an unprecedented time. The speed and the violence and the magnitude of the volatility that we experienced a year ago was unforeseen, right? It was like, you know, multiple different events kind of happening at the same time. But I do think that folks, you know, cooler heads have prevailed, you know, like, you know, the sky seemed like it was falling for some, especially depending on what sector you're in. So I certainly don't want to minimize the impact of our small business owners and, you know, restaurateurs and people who own things like real estate and things of that nature. Mm-hmm. Certainly don't want to minimize the impact of that because some folks really were in a crunch. And, you know, fortunately, things like PPP were available for those business owners to take advantage of that and make sure that they continue to keep their employees employed and have enough cash flow to kind of keep the business up and running. But, you know, what I found is that most folks said, hey, look, this is, you know, this is something that is, you know, I'm in this for the long term. I'm not here to make a quick buck. I'm really investing, right? And I think that when you have a 10-year bull market, you know, the way we have, it's easy maybe for newer folks to just kind of be dissuaded from that. But by and large, what we found is that most folks have a bigger picture orientation, and we're really thinking about, you know, looking at this on the other side. And if you're retired or approaching retirement, and you were really concerned about your assets and your inability to potentially retire as a result of the volatility, maybe you've probably taken a little bit too much risk in the first place, right? And so it's a good opportunity to kind of reevaluate things by and large. So, you know, that's kind of what I saw from my side. Now, you know, there's a lot of people who lost their jobs, and there's a lot of people who aren't fortunate enough to be able to continue to you know, save in their retirement accounts and things of that nature. So I think what we have to do is be very specific as it relates to who we're thinking about, who we're talking to. And I know that's what Robert keeps leading with, is talking about how investing is personal. So I think that's when we think very specifically and very strategically about the individuals, their specific circumstances and their ability to be able to do certain things. And that's where seeking counsel and working with a financial advisor, or talking to somebody who's really on the up and up on this stuff, who can maybe just serve as a sounding board to help you think big picture, allows you to maybe not necessarily make a mistake.
Yeah, those are all really good points. And I think what you said is an excellent point, that what happened in 2008, 2009, it was identifiable. Not everyone was involved in the mortgage and the housing crisis specifically, but what's happening with the pandemic in 2020 and 2021, all of us globally, all age groups are very well aware of this. So again, looking at the silver lining, there could be some really good lessons learned here. And I think that's important to point out as well, because it's, you know, if we could almost compare the conversation that we had from last year to what we're having now, I never would have expected. And Robert, I'm sure you'll agree with this because we spoke about this offline, that we would be where we are right now. And I think, you know, there are many dynamics that have shifted as a result of this. Robert, did you want to follow up on that?
So, you know, when I think about retirement and the dynamics that we've gone through, you know, our retirement plans have the majority of the plans that are defined contribution plans that Anthony highlighted. The annual contribution amount continues to go up. And so, you know, today you can put up to 23,000, I think 23,500, and there's a match, a catch-up amount if you're a little bit older. You can put in almost, I think 26,000 into a plan. People should be fully funding and investing that money appropriately, not over the top, but, you know, there's probably not a lot of real benefit in having a lot of fixed income right now with the yield, I think you got to go out, 20 years to get 2%. So there's just no yield in fixed income. And you can diversify very well. Most of the plans have a really diversified menu. But, again, it's personal. So you got to kind of, do it one person at a time. But you could be fully funded. And if, in fact, you find that you've overcommitted, if you will, most of these plans have either a loan feature to it. If you're old enough, there's ability to take a withdrawal. I don't recommend that. There's penalties if you're not 59 and a half yet, but there is some access to some of that money if in fact you need it. But that would be the last place, that you should be drawing on. And retirement, it varies, it's personal, but a lot of people are going to be in retirement for 20 years. 25 years, 30 years. How often do, a lot of people can point to the generation ahead where you've got, 85-year-old, 89-year-old, 90-year-old grandparents. And so we're going to be retired for a long time. So they need to really have a long horizon and not just think, oh, when I retire at age, whatever it might be, 60, 65, whatever age you pick. I think there's now talk about lowering the entry point for Medicaid and for Medicare. And so a lot of people try to wait until they can get to that government retirement plan because private insurance and COBRA is really expensive. And so a lot of people were working longer just to get to that level. It looks like we're going to have opportunities if this legislation goes through to get access to those plans earlier. So, and a lot of people, when they retire, they don't stop working. They may end the career that they've been in, but there's so many people that I know that are doing different things. They're starting consulting businesses, lifestyle businesses. They're taking advantage of the cumulative knowledge they have, and they're going back and working as consultants in the industry that they worked in full time. But they're only working 2 or 3 days a week. And so people are doing interesting things. People are downsizing, lowering their overhead, selling a big house and getting a much smaller place. And instead of spending all their money on the real estate they live in, they're traveling more. And so they're getting out and doing things. So I find that retirement's not, it's not sit at home and, be on a fixed income. People are really getting out and living and having very full lives. And so they may in fact make more money in retirement than they did before in some cases. I can't tell you how many friends that I know that are now, they've gone through these coaching certification programs. And so they may be retired from a 20 or 30 year career, but they got all this expertise, not at coaching, 40-year-olds on, how to have a balanced life and all the sort of things that life things that come through wisdom and making a lot of mistakes. And so now they're going back and capitalizing on that. So I think, I like to ask people, what's your vision of your retirement? And I've yet to have anybody say it's going to be slow and boring and I'm going to kind of kick back. Most people are planning on doing something else.
You know what? This reminds me of a trend that we were talking about, at least covering in financial media prior to the pandemic, what's called FIRE retirement. If anyone has any thoughts on that, I'd be really interested to know, because Robert, to your point, we're living longer, which means either we're going to be working forever or we'll be taking on different kinds of roles. But there was this movement with people who have been in the workforce maybe 10, 15 years, where they virtually saved every single thing they could to retire in their 30s and then live the rest of their lives, either traveling or going to school or whatever. And I guess I'm a little bit, well, I'm definitely too old for that generation, but it goes that, like, what, is that a sound retirement plan? I don't think I'd recommend that as a planner. There's so many things that can go wrong, from age 30 to, the time you expire.
Well, 30 is pretty young.
Yeah, that's what these retirement plans, FIRE, FIRE plans recommend.
You know, people are doing different things today. I mean, I don't know if you've ever seen any of these small homes.
Tiny house, tiny house,
What'd you call it?
tiny house.
Yeah, people, you know, that's not for me, but people are doing stuff like that. People are deciding they want to go see the country, and they've lived maybe in one area, and they liquidate some things and go buy a big, beautiful, like a bus, a RV, and literally travel around the country, experiencing different things. And you know, it's interesting. There are still people who have pensions, and so if you are if you have a career, it's a public employee, state pension funds. If you're a teacher, a firefighter, or a police officer, you know, a lot of those careers start young, and by the time they're 45, they got enough time in to retire on a full pension. Think, you know, so it's there's a 25 years and then a certain age, and when they hit that age, they can retire and they get almost 2/3 of the income that they made when they were working, and they're 45, 50 years old. They go out and get another job, do other things. So people live differently and make different kinds of decisions on that regard. You know, us Wall Street types, we try to, you know, make all the money we can and invest it. And but I find it's not unusual to see somebody in the wealth management business who's you know, 65, 70 years old, and you ask them about retirement and they say, I love what I do. I enjoy the people I meet. I love my work. I'm not really planning on retiring anytime soon. So you get both ends of it.
Mm-hmm.
So Jill, just to add on to that for your part of your question, I think that Robert, that was definitely great in terms of people want different things, and it depends. So you asked, one of the questions was, is it as a planner, or would we recommend this? It will depend, but just to get to your point, let's say if someone is 30 and their full retirement age is 67, that's another 30 plus, plus years. And then we're expected to live, right, 20, 25 years into retirement. So you really have to add all of that up. You want to make sure you have all the information. And I saw someone also put something in the chat about watching for the FIRE movement. For those who don't understand, this is Financial Independence Retire Early movement, which is a big, pretty large movement, and a lot of people are doing it. I have some friends who have literally rented out their homes and then moved into a room within another property just to save more money and provide a lifestyle that they want to actually live. So I would definitely encourage people to seek the right level of advice if they are going to do that. And the question was around, someone wants to know how they can achieve this in the next 5 years. One of the things I would say, you would have to get really scrappy, and it depends on your situation. What's your debt? What's your debt load? What do your assets look like? What will you be able to draw from? How do you plan on sustaining yourself? What's your level of expenses? So there's so many other things. And then to factor in the scenarios of the unknown. So then you kind of have to like calibrate these scenarios that no one thinks they're going to happen to them, when many times people right now on this call, there's a percentage of us that will become disabled at some point in time over our work career. And I don't mean that in any way that I'm claiming that any of us are going to be disabled, but that's a possibility. Do you have the right level of insurances? There's just so many things that you would have to consider and measure if you have children, if you have a family, and but people are doing it, and I wouldn't discourage anyone from doing it. I would say to seek the right advice and guidance for your situation, and then look at the time horizon that you are actually looking to do that.
Yeah, those are, and again, it goes back to what the three of you have been saying. Time horizon is key with anything, whether you're trading or whether you're investing. But I just, not to belabor the point here, I would agree with you. There are so many unknowns that are out there, and we were talking about the tiny house movement before as well. I just can't imagine, and this is my own experience, packing the entire family in a 300 square foot home in the effort to save. We work on like 2 different levels in this house because I just can't be that close to someone all that time. So it really is personal, and it all is on time horizon. And I want to shift gears a little bit here before we get into Q&A. And I also want to remind everyone, please include your questions in the chat function or in the Q&A function, so we can get to everything. But we are in tax season. Typically, it would have been done on April 15th, but now it's to May 15th. Could you provide a high-level overview of how things are different this year, what you're advising clients to do, what are some advantages that we can find either through savings or elsewhere?
Yeah, definitely. I mean, so there's some things that have changed because of the CARES Act, for instance, as it regards to taxation, and you guys feel free to elaborate. I'll just mention a few things. And then Biden is going to speak tonight as well. I believe it's at 9 p.m. So there'll be more information that comes out. So we mentioned about people were able to take some early withdrawals from their qualified retirement plans up to a certain amount, up to 100,000, or a certain percentage of their vested account balance without having a prepayment penalty of 10%. You still will be taxed on that money, but potentially if it's for a reason that you were diagnosed with COVID or some other sickness that happened because of the pandemic, you have a longer time period to pretty much pay that money back. If you want to, usually after the Tax Cuts and Jobs Act, the standard deduction actually increased pretty drastically. So much more people do not itemize as historically, but what Congress is doing now to encourage taxpayers to help out charities is, even if you're not itemizing, so you can actually take a $300 deduction if you gave to a charitable organization. So that's for you to encourage us to give for charitable organizations. And in terms of the child tax credit, so for 2021, for people who have children, this is expected to be larger than what it is currently. So between $3,000 and $3,600 for the child tax credit, and some of that money is expected to be paid out in advance, like prepaid. So and what a tax credit is, just for people who may not understand, this actually reduces your tax liability dollar for dollar. So it's really helpful for whatever amount you're expected to owe back, if any. Some people, I would say, depending on their situation, you may have more people who qualify for the earned income credit, Jill, for this tax season, since it's due by May 15th, than in prior years, just because at one point where we were with the rate of unemployment. I do want to just be mindful, because I know as a CPA, people have been asking a lot of questions about, oh, I work from home. Can I take a deduction from, now everybody has a home office, however it looks or wherever it is. But this is still designated for self-employed and independent contractors. And you have to use it exclusively and regularly as your principal place of business. And so if you work for an employer and you're getting W-2 income, you can actually not take this deduction. And that's because of the changes from the last tax law changes. And so those provisions don't end until, I believe, 2025. So unfortunately, that's not something that people will be able to take advantage of. But we definitely encourage everyone. I believe Anthony already mentioned that if you can, to max out your 401k, don't leave money on the table. Many companies at one point during the height of the pandemic, they had stopped giving a certain amount of contributions, but the faucet has turned back on in many instances. So get that match that you can get. And then I would say with social media now, and so many people who have opened up brokerage accounts over the last year, I would encourage people to look at companies that you're interested in. I know a lot of people are not taking the train anymore. I used to, when taking the train, you can actually see what people are interested in. Okay, what are they buying? What are they wearing? What are they looking at? So even though people are not taking public transportation as much, still get out, be aware, and take a look at what's going on. Get into some type of media outlet that you're interested in to find out some information, because the barriers are very low at this point, where the level of information that's coming forward for people to use it, and maybe you need some help to actually digest it or understand some of it. But I would definitely encourage people to join some of these platforms to stay in the loop, and to learn as much as they can about investing, and even look into companies that you already are familiar with, that you love. You already buy these brands. You know a lot of your friends that buy those brands. That's a good place to start.
Yeah, all really excellent points. And you're so right about looking at what people are wearing. I can remember when the athleisure trend really started to become a thing, and certainly COVID accelerated that with the pandemic. I mean, you could just take a look at Lululemon stock and certainly see the returns, as it is reflective of what we're seeing in society. Even the Apple earnings number came out tonight, and it totally crushed analyst estimates, because these are the devices that people are using. They need to bring more laptops into their homes. Enterprise is starting to integrate more Apple software into. So you're so right about looking at what you see on the outside, what brands that are recognizable, and what you understand. So that was a really great point. Anthony, I'd like to go to you next. Anything around tax season that you would recommend besides the 401k contributions?
Yeah, I mean, I think tax is a very nuanced thing, and so we're not allowed to give tax advice, nor would I recommend anybody take tax advice from me, because I don't have a tax background. But I think it's really important to seek counsel from an individual, if you have who's a specialist, who's an expert, who understands tax. I'm a big person who believes in the value of advice. Because there may be something that you miss, or there may be something that changes, or there may be something that's applicable to you now that wasn't applicable to you before. So, that's my general orientation. There's a lot of do-it-yourselfers out there. And I would say that, probably in the short term, the do-it-yourselfers who are investing are probably having a little bit more success than the do-it-yourselfers who are doing their own taxes. So, it's something that I heavily lean on for clients. The way we run our practices, we really try to get to know our clients' tax attorneys and the trust and estate attorneys as well. But that's my general orientation, is just to seek counsel from an individual who's an expert, because a lot of this stuff is nuanced. And then I also try, I do try to recommend to clients not to necessarily think about, try to skate to the puck as it relates to how they think things may change, right? There's a lot of, legislation on the table. There's a lot of whispers about different ways in which we're going to pay for all the stimulus. Are we going to be taxed at long-term cap gains? Is long-term cap gains going to be taxed at ordinary income? How does all this kind of stuff shake out? Should I be liquidating stuff now because I'll pay a higher tax bracket later? It's really difficult to make a lot of those decisions, especially because getting laws changed, especially tax laws, is really burdensome. So, what we try to really do in the probability of something happening and being retroactive and having an impact on your current situation right now is very slim potentially, right? So I would always recommend, especially for those who have dynamic situations, who may have a little bit more complicated situations, to certainly lean on a professional who can help provide some guidance in that regard.
Robert, I see you shaking your head in agreement there. Any follow-up?
Oftentimes we talk about taxes, people focus on income tax. My client base is very wealthy. And so one of the things that we try to get people to pay attention to is if they have highly appreciated assets, gifting strategies, wealth transfer, getting some of those assets off of their balance sheet so that capital gains tax gets paid by maybe an entity that has a much lower tax bracket. Donor advised funds, have been very popular lately because people can make the gift now, and then they can give the funds away later. And they don't have to decide exactly where all the funds go right away. Once they make the gift into the donor advised fund, they qualify. And that way they can kind of batch together their gifting. So, you know, people tend to, you know, give money to their colleges. They give money to maybe a religious institution. They give money to some nonprofits that they believe in. And sometimes they do small gifts at random times during the year. Maybe there's an event or a gala or something of that nature. And they give when the events occur. And so by using the donor advised fund, you can establish a budget. So I want to give away X amount in total, and then make the gift, even though the actual giving may occur at different times. So those are some of the ideas that we are encouraging people to get some advice from their tax advisor. And because the tax laws are changing so much, the other thing that we try to get people to do is just be focused on what's happening now, because, you know, what we think may happen may not happen, and you can miss opportunities. So let's just take advantage of what we know today. And when things change, we'll have to adapt. It's hard to do pre-planning because you just really don't know what's going to pass and what's not. And we leave that up to the you know, the CPAs of the world to provide that kind of, you know, in-depth counseling for the clients.
Yeah.
And the perfect segue into our Q&A, and Christina, we're going to kick this one off for you because I see a tax question in there. But two notes real quick as we get into our last 10 minutes here before our closing remarks. If you have any questions, just throw it into the chat. What we don't get to, we can always follow up on. But apparently we're also giving away an Amazon gift card. So be sure that you check in with the chat, fill out the survey on SurveyMonkey, and the first 25 people to complete it will get a chance to win an Amazon gift card. So that's exciting. And Christina, with that, there's a question around 1099 here. Have there been any changes to what 1099 taxpayers can itemize? Is there a limit or income bracket that is considered?
Yeah, so what I was saying before is just about the standard deduction, and so that was doubled. So for single filers, it's over $12,000, and if you're married filing joint, it's pretty much double that. And so this has drastically increased, and so we need to first see if you are eligible to itemize, but there's standard things that are still, you can still actually deduct, like your self-employment tax, obviously. If you have your home office, as I mentioned, certain percentage of your meals, you can still deduct that. So it's some of the usual things. I can get back to you if there's any other additional changes. So I mean, I don't focus on tax regularly, day in and day out, and as Robert mentioned, that there's always changes. So even if you don't fully hear about them on a large scale, there's always updates in the rulings. So last name McNeil, I will not try to pronounce your first name. I hope that can help you a bit, but you can feel free to reach out as well.
All right. We have another 5 minutes for questions if we have any last minute ones out there. And then just to remind everyone to complete that survey. The person who gives us the highest rating is going to get the Amazon gift card. Just kidding, it doesn't work like that. But we strongly encourage you to fill out these surveys. It only helps us provide better content going forward. So we do appreciate that. And then, you know what, while we're waiting for some last minute questions to come through as we're nearing towards the end, you know, I'd like to go with the three of you, take a minute or two, recap some high level thoughts, best practices that you're focusing on for 2021 and beyond. So let's just go around the horn again. Robert, we'll start with you. Christina, if you want to follow up, and Anthony, we'll have you drive this home.
You know, I encourage people to have a short term and a sort of a longer term plan. You know, oftentimes when we do planning, it really is a snapshot of today. And so I try to encourage people to say, think about over the next 5 years, what might you change in your plan? What are some of the ideas or things that are important to you? And just think about where you'll be in 5 years. How will your kids be? How old will your spouse be? You know, what are some of the things that are important to you? You still want to live in the same place, and you know, encourage people to think a little differently and see their plan as something that's dynamic and not something that's fixed. You know, things change. You know, do some what if scenarios. You know, if I were to get laid off, what would I do? Would I stay in the industry? Would I pursue something totally different? Good friend of mine went back to school and got a PhD in had a master's in healthcare, but went and got a PhD. And you know, they wouldn't have done that, but they were working at home. They had more time, and so decided to go ahead and finish up some things they had to do on their bucket list, if you will. And so I just say to people, think outside the box and try to plan for it and do what if scenarios. And that helps people a lot. Oftentimes people say, well, I want to move to Florida. And I say, really? Where? What city? What community? What kind of house do you want to buy? How much would that, you know, go on Zillow and look up houses in that community and really see what they cost. And because you might discover that you could do that now. You don't need to wait. And try to get people to sort of take their ideas and their dreams and sort of bring them to reality. Oftentimes people don't do a lot of things because they don't realize they can.
Yeah,
all right.
Thank you. Thank you, Robert. So I'll follow up on that and just say, if one of the things for the pandemic, like a huge takeaway, is we have to just take in the moments and be present, right? And enjoy the moments that we have. You go in your fridge, for instance, you see your milk, you see your yogurts or whatever you have in your fridge, and it all has an expiration date, but none of us know what our expiration date will be. And so I would encourage all of us to really pursue our goals relentlessly, and whatever that may be. If it may be your financial goals, your personal goals for your family, really go after those. And if anything, during this pandemic, I've seen a lot more people coming to get financial advice and just asking questions and looking to right size everything. So I would encourage everyone to definitely take stock of where you are, look at where you want to go, but also have a little bit of fun in there as well, right? And just enjoy yourself and take a balanced approach. So you do want to have a plan, as Robert said, a short-term and a long-term plan, but to also build in some time for fun, some time for family, some time for friends, and some time to be present. So if you don't have a budget, this is the time to set up that budget. If you don't have a financial plan, this is the time to set up that financial plan. Don't worry about, okay, I should have started 10 years ago. I should have started 30 years ago. You can start at any time, and then you can work with someone to help you calibrate exactly where you need to be and how you need to go there. But I would also say, build in some cushion and build in some fun. I'll turn it over to Anthony.
Thanks, Christina. My closing remark is to just not be confused, right? Investment management, investing in stocks and bonds and mutual funds and index funds and private equity and hedge funds, that's not wealth management, right? Like, and so, you know, I think about just the coordinated effort that all the different moving pieces of the puzzle that we all have in our financial lives. And so if we can think about all of that stuff in tandem and how they all like work together, I think that that's where the magic starts to happen, right? So being organized, making sure that you have a sound investment management plan, of course, makes sense, especially because it allows you to think bigger picture and have a longer dated time horizon. But, you know, I'm still, well, I'm not surprised anymore because I've been doing this for so long, but you'd all be shocked at how many high net worth and ultra high net worth individuals who are worth, you know, a lot of money, right? Who don't have wills and healthcare proxies and power of attorneys, and or they have like minors for children, they don't have guardianship appointed, or, you know, maybe folks don't have a will, or don't have kids, and they say, hey, you know, my assets I want to really give to my nephews and my nieces, but I don't have a will. And I say, hey, well, guess what? That money's not going to any of those folks, right? And so it's really important to just kind of think about that. And then also, as one thing is reacting, the other thing is something else is having another effect as well. So we're in a historical low interest rate environment. So maybe the game plan might be to refinance your mortgage, lower the cost of capital on your balance sheet. Maybe you found enough dollars. Maybe you saved some dollars that you can use to fund education for your children. Or maybe you found some dollars that you can use to fund that life insurance policy that you really, you know, been kind of getting around to, but you haven't done it, or you haven't found the extra dollars to do it. And so I think about coordination of all of this stuff. How do we think about planning, organization, trust and estate work, working with your tax advisor, working with an investment professional, making sure that the insurances and all that stuff is in place, and then consistently checking yourself to make sure that you're on track in all those different areas. And that coordination, I think, is what ultimately helps people get to where they really want to be without worrying about any blind spots or tail risks. So that's my like parting moment or parting message.
All right, awesome. Anthony, thank you so much. I feel like I just went to the most amazing class after spending time with you guys. I had the same feeling that we did last year as well. So really appreciative for that. Great spending time with you as always. We look forward to the next event. And for closing remarks, I just want to toss it over to Andrew Hamilton and wish everyone a great night, and thank you.
Good evening, everyone. I'd like to thank so much the National Black MBA headquarters. I'd like to thank Joe Handy, Paula Fontana, and Robin for allowing us to put this program together. I'd like to thank our great partners from Nasdaq, Jill and Supriya, once again supporting this important topic, because again, financial literacy is really making an impact on our community, and we really want to develop legacy breakers or legacy makers as we progress forward. Thank the panelists again, the experts. I cannot thank again Robert. I can't thank again Christina and Anthony for their knowledge and wisdom, and also to you, the community, the membership that we serve every day in and out as we progress forward. Again, a piece of survey is very important. That's how we know how to craft and how to draft our content moving forward. But I like to leave you with this. I like to use the word variance. Variant right now is a very bad word because of COVID, but I want to use variant in the terms of financial planning. We hope these programs are variant in your planning. We hope that we're changing and making changes that are positive for you to move forward. And I think that's one of the things we do here at National Black MBA. And we want to leave you with that we operate with the community in mind. And with that being said, we want us always to join us in these programs that drive our community going forward. So on behalf of the Metro NY Chapter of the National Black MBA, special thanks to Chuck Roberts, special thanks to Marvin Vasquez, and also to my 40 other chapter colleagues. I wish you a very happy Wednesday evening, and look out for more events for us in the future. Thank you.